He says to the New York Times, "I'd lie if I said every piece of documentation was properly signed and dated. In our world, these things were tolerated." The Times quotes other people at the bank saying that a thin file was a good file. If people went and tried to verify some of the statements on the loan applications, they were told not to do so. There was a Academy Awards in 2003 for the bank called the Power of Yes, which is kind of famous in a current Jim Carrey movie called Yes Man. But in that case it was a movie, in this case it was real life. So, for example, with the power of yes and not really checking people's income, the home lending unit revenue went from $700 million in 2002 to $2 billion just the following year. In 3 years, the branches grew 70%. They had 2,200 branches in 38 states. They had offbeat television ads with casually dressed WAMU employees ridiculing state bankers. An official, on one occasion, one loan officer asked for verification of an applicant's assets. The officer sent a letter from a bank showing a balance of $150,000 in the borrower's account. But when this person called the bank to confirm, she was told that the balance was only $5,000. Her boss yells at her, "But we don't call the banks to verify the assets." So she claims that they spent approximately 35 minutes on each file to approve them. The kind of loans these were what's called stated loans where the borrower simply states their income and has no proof of the income. This is unusual and usually is reserved for self-employed people with great credit scores and high amount of assets. If they can't verify the income, at least they should have a lot of assets. So they were going on merely credit scores. There's one couple here with a fixed income of $3,000 a month that claimed $13,000 of income. And then they would put them into a loan which was called an option arm. And an option arm is a loan where you don't have to pay the full amount of interest each month. You have the option to pay less. In fact, you could pay the principal plus about 1% interest per month and defer the rest of the interest to later. And the interest that's on the contract is higher than the normal interest rate. So if you really believe you're going to collect all the interest, you book that loan at a substantial profit because it's a higher than normal interest rate loan. But the reality was that many of these people couldn't make the payment at all. So Washington Mutual went out of business not too long after that. It had approximately, I think, the government had to put in $25 billion to cover the bad loans, and that was on top of a investment made just before the company went bankrupt by Texas Pacific Group, one of the well-known investors in the United States, and they put in $7 billion just before the company went bankrupt. So there was more than $32 billion of worthless loans on the books of Washington Mutual. During this time, the fellow we quoted at the beginning, the CEO of the company, made over $100 million of personal compensation of bonuses and stock sales. So you had a system here where looking the other way, intentionally looking the other way, rewarded the management of the company at the expense of the shareholders and the depositors and ultimately we the taxpayers. So that is a very dangerous situation, and that was repeated at bank after bank all across the United States for many of these companies that just didn't care and wanted to take the quickest short-term profit they could get. And you saw that with Lehman Brothers that also dissolved. You saw that with Bear Stearns. You saw that with one of our most storied institutions here in New York, AIG, American International Group. AIG had was believed to have a true AAA rating, one of the most secure companies out there. And perhaps unlike Lehman Brothers, it was not as leveraged, and I think that many people in the market really believed that AIG was a AAA rated company. But what they had done is they had gone another type of financial instrument called a credit default swap, credit default insurance. And they had insured billions and billions of dollars of other people's loans. They had taken income into the income statement now, cash income, for writing the insurance. But then when they had a problem and they were no longer AAA rated, those credit default insurance policies defaulted and had to be replaced. So the government had to step in, put billions and billions of dollars into AIG, basically in order to save the counterparties, the other parties like Goldman Sachs and other companies that were on the other sides of the trades. So then this was, again, a short-term versus long-term situation where they were able to take income immediately, short-term, pay large bonuses to management, keep the stock price high, but ultimately, in the long term, the company didn't have the money to pay on those insurance policies. So this type of corporate strategy is another embarrassment. Another recent embarrassment, a really big one, is Citibank, where our former Treasury Secretary Robert Rubin was one of the top people. Well more than $100 million in compensation went out to the top officers during the last few years. And again, there were $25 to $50 billion or more of loans on the books of that company that were worthless. So basically, in a bank, you have the danger that you are funding the company with short-term deposits or short-term income, but taking on long-term obligations, in the case of AIG, or lending the money long-term, as in the case of Washington Mutual or Citibank. So that's the fundamental problem for any financial institution. They're trying to out-earn their cost of capital. The management, the boards of directors, they're looking to earn more than the cost of capital, the amount they have to pay depositors, the amount they have to pay for CDs, or the amount it costs to operate the branch network. They want to out-earn that cost of capital by putting the money out long-term in something that will pay them money. But it's risky. It's always a tricky business. And either they may take on too much risk, they may take on transactions that don't have any real profit, they may take on transactions that don't pay back, they may also leverage the company by borrowing money on the company itself and not being able to pay that back. So a financial institution is a very tricky company to run.